Hi, this is Sharon Lewis with LBS Tax and Accounting. I want to give you a presentation on the One Big Beautiful Bill Act. I call it One Big Beautiful Presentation, but I want to talk to you about this tax law. This is going to be a plain talk guide to the tax law that changes everything. Now, I've been doing taxes for about 24 years, and this is one of the most sweeping tax law changes that I have ever been a witness to. And I've gone through these, every 3 or 4 years, Congress and whatever presidential party comes in makes another tax law change. And this one is wide sweeping, makes some things permanent that are exciting for us, as well as having something for just about everybody. So it's not just for business owners. It's not just to make the wealthy wealthier. It's for everybody. And the idea, just so you know about why tax bills pass, is one of the things is that the goal of the tax bill is to stimulate the economy and to get more money coming through. So if we have the One Big Beautiful Bill and it creates more jobs or creates more money that can be spent, it causes money that would be going to the government instead to be going to generate revenue for businesses, keeping more people employed. Thus, we're not having unemployment used as much and different things like that. So the idea is to keep businesses moving so that we can employ people, so that more tax dollars come in from more people making more money versus let's taking it from businesses and individuals so fewer people work. So I hope that makes sense as to why there's these tax law changes, because everybody's like, why does this constantly keep happening? Well, the idea is they're trying to refine a system that everybody has an opinion on. So let's go through some of these changes, and I'll try and make this as interesting as possible. I'm trying not to make this alphabet soup or anything like this. So let's just talk about what One Big Beautiful Bill has. As I said, it is not just designed for business owners. Let me move this over to here. It is designed for families. It is designed for people who are on Social Security disability or even people who are receiving Social Security. There are benefits to everybody through this tax bill. The next thing is it's going to be real savings, and there's going to be some compliance changes that affect individuals. And what I mean is compliance changing is some of the regulations that we've had in the past have been harder for small businesses to utilize, and this makes it easier for us to take advantage of these. Because let's face it, 70% or 80% of the American public is actually employed by small businesses. So the more you can help small businesses, the more we can help, other people that are working in our businesses. One of the cool things about this tax code is that it is actually simplifying things. So many times that the tax laws that go into effect that change are actually just for us accountants, and it's a series of alphabet soup that changes everything. Well, that's not the way this is. We're going to cut through the noise today. We're going to explain in real terms what the changes are, the reasons behind them, and what actions you should take to make this a benefit for your family, because some of these require action for you to actually get a benefit from. They just don't happen because you're sitting there. This isn't like a rebate check where they're just going to send you $600. You're going to have to do a few things in order to take advantage of these changes. That's one of the cool things I think about being an American taxpayer, is that our tax code is, if you can learn, you can choose different ways to minimize the amount of taxes. Unlike other countries where, you have a flat tax, they're going to pay, you're going to pay 15% of your income, here's your bill, and everybody pays 15% across the board or whatever it is. In our government, our economy, we adjust things to try and help stimulate things. So I think it's an interesting thing. That's probably one of the reasons why I studied taxes and found that, to be exciting. All right, so let's talk about big breaks for business owners. And I should have changed the order of this slide a little bit because I'm going to cover it in a little different order. Bonus depreciation is something that the accountant actually does, the tax professional does, when we actually look at what is the best way for a business owner to take a deduction for an investment in equipment or furniture or whatever that they're going to use for their business. So under different administrations, bonus depreciation has been adjusted. Sometimes it's 25%, sometimes it's 50%, sometimes it is 100%. It changes every few years on every administration, and it's been one of these things that's kind of nerve-wracking because you think you might be able to take bonus depreciation, but oh wait, that was last year's tax law. What depreciation is, for those that don't know, is when you make an investment into a piece of property. Let's just say I bought a new server for my office. I spent $5,000 for that. I don't get to deduct $5,000 for it because even though I spent $5,000 of real cash, I only get to take that over the life of the asset. The Congress has determined, or the IRS has determined, that a server is a 5-year piece of equipment, and so it would be replaced every 5 years. So I only get 1/5 every year, and that's just a simplified version. Bonus depreciation means that I can check a box in preparing the person's tax return, and they get that full $5,000 for that server deducted against their income this year. So if they made $100,000 in profit and they made that $5,000, instead of taking 1/5 of it, they're actually going to take the full $5,000, thus reducing their taxable income from $100,000 to $95,000. So that is actually an option for businesses. The next depreciation item I want to talk about is Section 179. So that's this middle one right here. That's this middle one right here. Section 179 is another type of depreciation, which is similar to bonus depreciation, where you're actually taking an accelerated depreciation, which is 100%. But there's different price levels or cost levels that you can use for bonus depreciation. So I'm only allowed to use a certain amount for bonus depreciation, but Section 179 limits have been increased. And Section 179, I dropped weight. Now it's up to $2.5 million. And so that helps larger businesses who are going to buy more expensive pieces of equipment be able to take an immediate deduction against their income for that purchase of that equipment. Now, one of these reasons why these two are important and why they're different from each other is, let's talk about an investment in it that if you're a business owner and you're looking to exit your business in a few years, whether you're going to sell it, whether somebody might be making an offer to buy it, or whether you're going to go into retirement. The different types of depreciation, whether it's Section 179 or the bonus depreciation, determine whether or not I'm going to add back the depreciation and have you actually have to pay a capital gain on the sale of the asset, or whether I'm not going to have to add that back and it just becomes, an asset that transferred to the new owner and there's no add back of depreciation against the original life. And so you can actually turn around and avoid having to have to pay tax on that. Let me give you a real world example. Client comes to me, he runs a plumbing company, they buy 4-panel trucks. The 4-panel truck costs $40,000. Okay. Client is 65 years old and is actually in talks with investors to purchase his business. He does not disclose this to me, or he turns around and says to me, no, we've decided we're going to put that off for a few years. I'm not going to retire now, what have you. This isn't a good time. Okay. He comes to me and says, I want to take Section 179 depreciation. I bought 2 of these $40,000 trucks for my plumbers to use. I say, great, we take the Section 179 depreciation. Lo and behold, he turns around and sells his business that next year. Well, Section 179 meant that he only got 1 year depreciation on those vehicles, which means he had to count back that $80,000 that we deducted as income. If he had told me that they were still going to be discussing the sale of the business and that it was tabled for the holidays or something, and had been a little bit more upfront about things, I would have put him on those vehicles on bonus depreciation. He would have gotten 100%, and then he wouldn't have had to pay any gain on the sale of those businesses, or what's called depreciation recapture. So it's a technicality that you guys may not need to know about, but it's something that you want to discuss with your tax professional as you're planning through what your life is going to look like and how your business is going to be operated. One of the other things that's really cool is this R&D expensing. If you're going to do R&D work in the United States, you're going to get 100% deduction immediately. And let me give you an example of this. I was talking to a friend of mine who works in a facility where they do both treatment of physical health and they also do mental health treatment, okay? And the billing company that they use, it's really good for physical health stuff. The insurance gets processed really well, and then they get their money quickly, and that works really great. But when they're treating people for mental health issues, those treatments, a lot of times they're not processed correctly because the software is not written for mental health, it's written for physical health, versus, you know, maybe they have one that's more for the psychological world, but then it doesn't have the right codings for the individual. I don't understand any of this stuff. This is all gobbledygook to me, like probably some of the tax stuff I talked to you about is gobbledygook. But she's saying we're talking to some investors about actually creating our own system for this. So real world example, they want to create a software system that fixes this particular problem. We go ahead, you know, this is they go ahead, they start a company that does this, they produce that. They could have, because they already had clients lined up for it or wherever they were going to do it, they could have made a profit right away. They could have taken immediate deduction for that had they actually taken the time to develop that within her organization. I don't know what's going on with that, but that was one of the real world examples we had talked about and how it could actually affect them. The next item on here is the interest deduction, which has to do with a business that's carrying a lot of capital loans. You have a lot of investments, maybe in real estate or other things. You can now deduct more interest expense than under the old rules. So if you're carrying a lot of investment debt, you may have been told based on your earnings to tax depreciation and amortization deduction that you can't deduct all of the interest that you paid because you exceeded the earnings allowable by the IRS. Well, they've changed that and made it bigger, so that's exciting. Under the Tax Cuts and Jobs Act, President Trump created something called Qualified Business Income Deduction, or QBI. QBI is a deduction that all business owners get. If you have an S Corp, you get it. If you have a partnership, you get it. If you have a sole proprietorship, you can have QBI. What it is it's a deduction of income. Oh, and it also works for real estate as well as some of your investment accounts through your financial advisor. What it does is it gives you a deduction for actually having an investment in a business and creating a business. And so the thresholds for it phases out based on certain income limitations, though. They increased the threshold for 2025 forward. And if you have a small business, you now have a minimum where you're going to get $400, which is great because in the past, you know, it wasn't available to all businesses if they were small businesses or didn't have sufficient income. Now we're going to see more of that come into effect. So this is great news for sole proprietors, S Corps and partnerships that may have phased out before. So this is a really great thing. What's really cool about this is this puts real cash back in people's pockets, which is what the goal of tax programs is to put cash back so we can spend it. This one here is a big deal to a lot of businesses. This is the income investment and reporting relief portion of it. Prior to 2026, we have been required to issue 1099s for people. It would be a 1099 miscellaneous or 1099 NEC, which is for non-employee compensation. 1099s were required if you issued payments to anybody over $600. It's now been increased to $2,000, and it's been indexed for inflation. Now, what I'm excited about is we've been doing these 1099s at $600 for as long as I have been in practice. It has not changed. So now it's gone up for $2,000, and every year it's going to go up a little bit. So you might hire, somebody to come and do an odd job for your business and would have had to chase them down for $600. Now, if they're going to do an odd job, maybe they're going to, help with cleaning up the property. Maybe they're going to turn around and help you move furniture around, whatever it is. Maybe it's the window washer. I'm not sure, but you're not paying him more than $2,000 a year. You can now not have to worry about issuing him a 1099. I see this being really beneficial for some industries like handymans and stuff like that who are working for commercial real estate or for real estate companies, because they're not going to have to worry about getting those 1099s and then the tax professional doing their books having to have to account for those and reconcile them to the books. So it saves money not only in the companies not having to have to issue the 1099s, but also getting the tax returns done, because we're not having to have to, tie these in and make sure all of them are accounted for correctly. The other thing that's on this slide is the repeal of the $600 third-party network transaction reports. So if you're using anything like PayPal, Venmo, Cash App, Zelle, those organizations were required starting a couple of years ago. They were told that they needed to start issuing 1099-Ks for anybody who got $600 or more deposited into their account. So if you transfer money to your child, and maybe you send them to more than $600 for the year, they could have gotten a 1099-K and had to report that as income or explain to the IRS that it was an income by checking a box. We don't know, because it had never came into fruition. It was just one of these things that had been talked about, and that they were trying to get these third-party reporting agencies to start reporting this information to the IRS and to us. The whole thing was nixed this last year, or during the OB3, and this will not happen. The 1099-Ks are only going to be issued for the amount of $20,000 or more than 200 transactions. And so this is really good for people who have more like hobby businesses, who are casual users. Maybe you have a garage sale. Could you imagine having a garage sale making $2,000 and then getting a 1099-K and having to have to say that this wasn't an actual, you weren't making money off of these, you were just getting stuff out of your house? Well, this eliminates that, which is what was going to happen. So for some of us, this is a really big deal. For others of you, it's like, yeah. So I think this is really a common sense fix that prevents confusion at tax time that could have happened. This is a great example of how OB3 actually simplifies tax compliance. It causes fewer headaches, fewer surprises, and fewer chances of why the IRS is asking, why does your income look so much higher than it has in the past? And these may just be one-off items, but that hadn't been reported. Now we're going to shift to how OB3 supports families. So the first is OB3 is for people who are on Social Security disability or Social Security supplemental. They're able to have something known as an ABLE account. What happened is that this allows individuals with disabilities to save money without jeopardizing their Social Security or Medicare eligibility. OB3 permanently increases the contribution limits and allows, so let's just go over the ABLE account first, okay? An ABLE account is an account that you can set up for someone who has a disability, and they can put money into it, or family members can put money into it. In the past, it has been hard for people on SSDI or supplemental Social Security to actually be able to save money. This happened personally. My brother was on disability after brain damage from a car accident. He could not save up money for a car because it interfered with his ability to get Medicaid and for his SSDI. If he saved money, they could actually take it away from him or take away his disability, saying, look, you're able to save money. You're really not disabled. We're going to take this away from you. Well, being able to save up money had nothing to do with it. He wasn't able to save money to buy a car. Could you imagine being told you can only save $2,000? What kind of a car are you going to get for $2,000? So he had to depend on family members to be able to provide these things for him. Well, the ABLE account now allows for people to save money. And in fact, in 2025, people can actually save up to $19,000. And if they're working a part-time job that does not offer a retirement plan, they can actually save an additional $1,000 for their retirement. So that is a big deal. The other thing is that a 529 plan, 529 plans were traditionally used for saving money for higher education for children. parents and grandparents and all of that would put money into a 529 plan, and it would grow tax deferred, and the money could be used for higher education when those people were of age. Here's the thing is, say that the disability happens and the person didn't get to use their 529 money, or only use part of their 529 money, or maybe there's leftover 529 money and the disability occurs. 529 money can now be rolled over into an ABLE account, and it doesn't affect the eligibility of the Social Security disability or anything like that. So this is a big deal for a community of people that are already struggling financially. This actually will help them out. The other thing that's really cool is the 529 plans, going back to the normal 529 plan. As I said, you take money, you set it aside, it grows tax deferred, and then the money can be used for higher education. A couple of years ago, it was expanded to include being able to pay through K through 12 education, including private schools and things like that. Now 529 money can also be used for trade schools, certifications related to getting employment, certifications for part of their educational process. So to give you an example, some people I know were studying for the A+ computer certification. To go and take that test takes a certain amount of money. You pass that test, you get your certification. Well, money from a 529 plan could be used to pay for the organization, that issues that A+ certification, and it could have been used to offset those expenses instead of the parents or the student actually having to pay for that out of pocket. The next one is kind of exciting. Student loan exclusion, employer paid, is now made permanent. So if you give you an example, I have a client who about 5 years ago had a young lady who had started with him in the mailroom. She was a summer mail clerk, worked her way up all the way through there. By the time he retired, she was actually acting as the general manager, and he spent the last 2 years of his business just stepping away and letting her run it. He goes, I can go travel, I can do this, I can do that. I just come in once a month, check in with her. She knows how to reach me when I'm traveling, but I can, do all of this. So he decided he wanted to pay for her student loans. The problem is, 5 years ago, it was taxable income to her. He couldn't pay the student loan directly because the benefit was to her, and if he did pay it, it was a non-deductible expense for him if he didn't want to count it as income for her. So he would still pay tax on that income. Now, if this law went into effect and they were still working together, he could have turned around and paid her student loan company, whether he paid it off in full or whether he made monthly payments. He could have paid for her education that she had got while she was working for him. So this is one of those benefits that can be paid to behalf of employees. What appears to be cool about this is it's not limited to just employees. Let me rephrase that. One of the things that's really cool about this law is that an employee doesn't need to be a full-time employee, and I employ my son. I might be able to use this to pay for his education. He actually does data entry during tax season, works with some of our back end of our software that's not tax prep or anything like that, does some of that. I might be able to use this by having him get a student loan, and then my company makes the payment on that. So I'm still investigating that, but the way my interpretation of the law is that if he gets a loan, I can pay for that. So that might be something that we look into the future. I'm probably going to be doing another class on that as a great tax planning tool. One thing is, my son does have a defined job. He does have defined hours. He does get a paycheck. He's on our payroll system, so it's not like I'm trying to breach the system and pay for my kid when he actually doesn't work here. My son actually does literally work here. In fact, he'll be here tomorrow. All right, so that is this particular provision on this. Next, leave tips and teams. Oh my. There was a lot of news in the press about this. So let's talk first about family paid medical leave. If you're a small employer, a lot of us don't offer paid family medical leave. In fact, because it is so hard to implement, trying to qualify for all the federal programs to be able to offer it to our employees, it's just easier not, and just say, take your time off, we're not going to pay you, and come back when you're ready, knowing that they're great employees and we want them, but let them go do what they want. Now, but we still feel bad because we want to be able to help them. Now, under this particular provision, it's expanded to allow employers to not have to fit into the square box that the federal government says you have to do this to do family paid medical leave. It has now made it easier for employers to be able to offer this. So this is a really cool thing for anybody who might need family paid medical leave and works for a small office, doctor's offices, tax offices, plumbing, painting offices, stuff like that. Those benefits might be available where they would have been foregone, and you would have had to work for larger companies to actually get paid medical leave. The next one has been all over the news since July 4th when OB3 was passed. No tax on tips and overtime. And let me break that down for you because there's different pieces to it and different parts to it. Tax on tips is got to be customary for that business in that industry. So I can't turn around and tell you that my tax fees now are only $100, but the recommended tip is $400 or $300 or whatever it is. I can't tell you what any of that. And then just say, look, my income was only $100. And the same thing goes with the doctor's office or a plumbing company or something like that. They can't say this is this, but here's what our tip or our suggested tip is, or required tip is. It's not customary for our businesses that we work on tips, but your hairdresser's tips, your nail salon, your massage person, the waiter and wait staff, the busboy, the bartender, all of those people that customarily get tips, the concierge at the hotels that customarily get tips, those people will have no tax on tips in 2025. However, it's limited to $25,000 in tips. So if you're working in some place, maybe like Las Vegas or Hawaii, where there might be more tips coming in because of how busy tourism is, you might bypass that $25,000 worth of tips, and those tips would then be taxable. So employers will still continue to need to track tips. It will still be most likely reportable, and some of them, because they're going to have to make sure that you're not exceeding that $25,000 threshold, but it won't be taxed or reported on the tax return. It'll just be reportable on tax forms. So there's going to be some hoops that we all have to jump through on the compliance side for those of us who do the back end paperwork, but it'll make it easier for you guys. The other thing is no tax on overtime. That too has a limitation on it. That limitation is up to $150,000. So if your income exceeds that, you are not going to get away with no tax on overtime. Think about like the dock worker, the certain nurses or people in medical fields, pilots, just certain people who actually get paid on an hourly rate that are making high-end wages. They might exceed that $150,000 and have to pay tax on their overtime. But people who are working, as intel or janitorial or different jobs where you're not going to be getting paid those higher-end wages, they're not going to have to pay tax on that overtime, which is going to give them real money to spend in the economy. So give you an example, my nephew works at a chip fabricating company as a tech support position, and so he does a lot of running around and on-call stuff, and he gets paid overtime for it. And so he's super excited about this because he's going to be keeping, of say, the $30 an hour he makes in overtime, he's going to be keeping more of that and not having to have to give as much to the federal government. So he's excited about that. What's really cool is this is both of those on no tax on tips and overtime really supports people who are on Social Security disability and are working part-time, because if you're working as a waiter or waitress with a disability, you're able to keep more of that. If you're able to work in some of those jobs, you're able to keep more of that tip money. And so that will help them to be able to have spending money, because that won't go against their Social Security disability income that they're maxed out at. So, I know when my brother was on Social Security disability, he was only allowed to make $17,000. And so if he had worked at a job where he had gotten tips, he could have exceeded that $17,000 in tip income and not had to worry about there being ramifications from Social Security. So that's a real world example that is beneficial to, the community. All right, let's see what's next in here. Investment reporting and relief. This one is not designed for immediate cash into the economy, but it's to develop things that are better for all of our communities. So let's first talk about the QSBS gain exclusion. Okay, this is for people who invest money into businesses. To give you an idea, one of my clients back in 1993, I believe it was, invested $25,000 into his nephew's manufacturing business. And when he invested that money, he was really hoping that it would pay off, was proud of his nephew. They had a great idea. And so they created whatever they were doing. And in 2018, they got an offer to sell that business for a couple $1 million. So my client's version of it was over $1 million. And so from his $25,000 investment, this QSBS gain exclusion allowed him to not pay tax on most of that money from that investment. Now, he had tax on other income, it was reported and all this other stuff, but he didn't have to pay tax on that. So figure he invested $25,000 back in 1993, and in 2017, he was actually able to get paid out $1 million for his investment in that business. Now, what the QSBS gain exclusion does, it gives it a faster timeline. I can't remember what the timeline that his was, but his fell into that. It also has higher limits, so if the payout was actually higher, there would be less tax. I don't remember what the limits are. This is one of those bizarre tax laws that I've only seen 1 or 2 times in my lifetime, but I know it's there, and I keep it in my back pocket when I hear about somebody having that potential. The other thing is opportunity zones have expanded. So what's really cool about the opportunity zones is these are areas in different counties. So the county determines what are the opportunity zones. And they're saying that this area of town needs to be improved. So for where I am, Mesa, Arizona has an opportunity zone. Phoenix has an opportunity zone. Tempe has an opportunity zone. I'm not sure if Chandler has one right now, but they have different zones that they've determined need economic development. And you could think a lot of places, your downtown blighted areas where you've seen that before. I remember driving through Baltimore years ago, and there was a blighted area. They were selling houses for, $14,000, which to me was unbelievable living where I live that anything would sell for that price. But that would be an area that may have been an opportunity zone. Anyway, they've extended and expanded the opportunity zones. What's cool about them is if you make an investment in an opportunity zone today and sell that property after you've improved it and done what's required to qualify for this, you end up with a tax-free capital gain. So I invest, say $250,000, or back then $14,000 on that property. I fixed it up. I did what I needed to do. I held it as a rental for 5 years in that community. I could have sold that property for maybe $100,000 and qualified for 100% of that gain of that excluded from my being taxable income to me. They've also included new markets tax credit, which is now made permanent. This encourages private investment in low-income communities. If you're interested in community-focused development or partnering on mission-aligned project, this adds considerable value. This actually, makes it so that you're going to keep more money from when the investment sells, and you're going to be paying fewer taxes because they want you to invest in these areas. They want you to help make these already existing areas that already have infrastructure in place better, or they might want to help create infrastructure in areas. I know where we live, there's some areas don't have as much infrastructure as needed to be able to service them. The next thing is low-income housing tax credit. Now, I saw in Arizona during COVID the exodus of a lot of properties who offered Section 8 housing and other low-income housing. I saw a lot of them turn around and basically evict those people or kick them out, not renew their leases, because they could rent the property for higher amounts, and they were all about chasing the buck. But that left the low-income community without any place to live. So where I am right now, there are very few options for people. Well, the government has turned around and said, we will help if you turn around and create these, we will help with that. So this is something, it doesn't apply to every business owner, but it might be something that will, pique your interest and get you to invest in that. So this slide isn't about, real cash or fast cash flow. It's about opportunities for growth, equity, and legacy and, planning. One of the things is this is one of those tax tools that requires foresight and saying, okay, where do I want to be in 5 years or 10 years? Just like if you're doing investments into retirements, this is one of those where you can turn around and say, where do I want to be, 5 years from now financially? If I do this, if I work in this, can I get to where I want to go? And get the tax relief from that money, because we all want to invest and have a capital gain, but then we don't want to pay 25% of our capital gain to the government because they weren't the one taking the risk. Well, this helps eliminate some of that 25% capital gain by doing these things, or whatever the capital gain rate will be in 5 years, or when a lot of these things first have the ability for you to liquidate and get the money out. All right, so now let's go to the next slide here. SSI specific wrap up. Okay, so this one is really kind of cool. Student loan discharge for disabled people is now tax free. So I'm going to use my poor brother as an example again. My brother was in college to study computer engineering, was 1 semester away from graduation, was in his car accident and left him brain damaged. Okay, he had student loans for college. And now he's stuck with having to have to work minimum wage jobs or slightly more than minimum wage because he can't retain his memory. The area of his brain that was affected didn't allow him to think clearly or remember things. That was his problem. He couldn't remember things. So he owes $30,000 for his degree. He's never going to be able to work in that area. What are we going to do? Well, back then, we had to file bankruptcy, or he had to file bankruptcy to be able to get this discharge, and then we had to write and work with the bankruptcy judge to get the student loans chargeable because they didn't want to let go, but they saw that this was, a problem. Today, under this new program, student loans, if you are determined disabled and qualify for SSDI or SSI, and the lender agrees with the SSDI, because you'll have to go through their protocol for it, your student loan discharge is not taxable. 5 years ago, when a friend of mine, she's a client of mine, when she was diagnosed as disabled, I believe she has fibromyalgia, when she was diagnosed disabled, she's in the middle of her PhD program. She did finish her PhD program, but they told her that they were going to discharge her student loan, but she was going to have to pay tax on it. So they discharged her student loans, and then so they discharged her $30,000, but lo and behold, she now owes tax on that. So now she's coming to me saying, how am I going to pay $6,000? I'm living on Social Security disability and a small pension that I qualified to take money out of. And we had to put together a payment plan for her. Well, now they're not going to be issuing those cancellation of debts for that, and that's what happened to her. So this is a really great avenue for people who are struggling with they're already struggling because they're not able to be fully employed. They're already struggling with a health issue, and now they're not going to be stuck with a tax debt for a student loan that they weren't able to pay on. What's even better is the parents who could have been given that cancellation of debt if they co-signed for their child's loan, if that child is disabled, they now also will not be getting that cancellation of debt. So this is a twofold, hooray, we did something good for the American people, is those disabled people now will not be having to have to pay tax on that, the income for money that was considered actually phantom money. The other thing that this also did is that if a student were to be killed, say that the mom and dad co-signed for the student loans, the student dies, there's still a student loan out there, or maybe it was grandma that had to co-sign on it. There's nobody taking advantage of that education because they're deceased. Those people do not have to, those loans can now be forgiven, and it is again tax-free to the family members. So this is a great strategy. The next thing is, you just think about all right. Flipping through my notes here. I have quite a few notes, just making sure I cover all of this stuff. Next is where we're going to re-emphasize the ABLE accounts. The tax advantage savings tools has always been underutilized because often people didn't know they exist or afraid of messing up their eligibility because it actually has to be an ABLE account. OB3 expanded the contribution limits, and it actually makes it easier for people to the rollovers from the 529 plans. It simplified that, which gives families incentive to use that. If you have a disabled loved one that's under the age of 26, these accounts are one of the best tools ever available. What's cool about all of these specific tax credits is that these help families build resources, plan ahead, and support disabled individuals that don't jeopardize their benefits like their SSDI and Medicare. I have seen time and time again where people lose this or are struggling because of not having the support they needed, and this is a great opportunity to help them with that. I've done a lot of work in the nonprofit sector and working with some people in these areas, and so these things are like really touch my heart in that great way. All right, other notable provisions. There's an enhancement of employer child care credit. This means if a business provides child care directly or even helps pay for employees' child care through a provider, they can claim a bigger and permanent tax credit. This is a powerful retention tool for keeping employees with a company. They might not necessarily be chasing the next raise if they know they're getting help with their child care through their employer. The other thing is that OB3 enhances the adoption tax credit, both in terms of the amount and accessibility. Because adoption is expensive and complicated, I know I've been through this. This expansion offers real financial support to families through the process. And what's great is it's indexed for inflation. The adoption tax credit was originally $15,000. I know that some adoptions cost a lot more than that by the time you're done with all the different studies and protocols that have to happen. Now, one thing about the adoption tax credit is if you know somebody who's going to be utilizing it, they will be audited once they take this tax credit. The IRS really wants to make sure that they qualify for it, that they didn't have a natural child or taking care of another child, that an adoption went through, and documentation will need to be provided for the IRS. But it's, we're actually going to see people who complete adoptions actually get real money back for them. The next thing is that this particular credit is now available for both domestic and international adoptions, and it is indexed for inflation, where in the past it has not gone up. It was at $15,000, it was at $15,000. It is now indexed for inflation so that it goes up as the cost of living goes up and as things like that happen. So these might not help you directly, but it might be something that the employers can help with. So what you need to do with OB3. So we're going to just wrap this up a little bit. First, if you own a business, let's revisit capital purchases and depreciation strategies. One of the things that might be the best thing for a business to do is to actually make a capital purchase instead of, stretching and saying we can get this piece of equipment to work one more year. Maybe this is the year to actually make that purchase so that you can utilize the Section 179 depreciation or the bonus depreciation and look at those capital purchase strategies. Even if you're going to finance it and take the interest, you now get to deduct that. So those are different tax planning things that you might want to sit down with your tax advisor to look at. The next thing is making sure your business is structured right to make sure you're getting the maximum amount of QBI and the benefits related to that. Then look at compliance to your 1099s. This is a reminder right now, for 2025, we are going to still need to do 1099s for the $600 threshold, unfortunately. For 2026 and forward, we do not. So now's a good time to be chasing after people and asking them for their W-9 if they've done work for you up over that $600 amount, just to make sure that you've got everything, you've got what you need, and you're not spending the month of December not enjoying your holiday, but chasing after people trying to make sure you're in line for tax season. If any of what I talked about is something that looks like it's going to be of benefit to you, talk to our team here at LBS Tax, or talk to your tax professional or your tax advisor before December. Seriously, book an appointment in September, October, November to go over what thresholds, because here's the thing, you want to make sure that you have time to utilize these, especially if you're doing any of the business strategies or any of the other strategies, planning for the future to make sure you have everything in line. And then you have to follow the protocols that we tell you are part of those specific things, because not all of these are just, oh, she just gave me a great idea, I'm going to go do this. You actually have to follow the rules. I've seen more people who come in who say, I want to do this, they Google it, they think they've got it down, and then they do it wrong, and then they're mad at tax time because they didn't follow the rules, and now they have to pay tax on that. So it's important that you sit down and talk to somebody, know what the rules are, so that you actually get the benefit of the tax law. There's no reason to have tax laws if we're not going to take advantage of them and utilize them to minimize how much the federal government is getting. All right, so just takeaways. OB3, one big beautiful bill, brings tax relief, it brings planning opportunities, and it makes compliance changes that make it better for people to be able to utilize the programs that the government has for us to be able to save on taxes. This helps business owners and families, but you must act with awareness and intention when you're doing these things. You cannot just turn around and punch your way into 2026 saying, I'm going to take advantage of OB3 without actually planning. I hope this really helped you out. Thank you for taking the time to watch and listen to this. I'm Sharon Lewis with LBS Tax. We know taxes, so you don't have to. Thank you very much.